Well, good afternoon and thanks for tuning in to Bloomberg Quint. Welcome to the Mutual Fund Show. I'm Neeraj Shah. It's Wednesday, 12:30 and your date with me wherein we talk all that you need to know about mutual funds. Every day or every episode, we pick up a theme and try and tell you how to best approach funds or mutual fund investing within that theme. The theme for this week is economic cycles and mutual funds. Now, I've just chosen a small graph here before we get into our guests and try and get their views about a stage of an economic cycle or stages of an economic cycle. And this is pretty normal. Any basic economic study will tell you that every economic cycle goes through a period of expansion, boom phase, there is a recession, there is a depression, and there's an expansion phase yet again. Now, you'll be trying to think, why am I talking about an economic cycle right now? Well, the reason is simple. While on a growth front for the country at large, we might be in the expansion phase or the boom phase, as the case may be. But if you look at specific pockets within this economic cycle, say infrastructure, for example, a lot of people will say that if we are not in the recession phase and if we are not in the depression phase, we are probably just here, somewhere around the start of the expansion phase. So the question is, guys, that if we are at the start of an expansion phase of infrastructure as a cycle, does it make sense to invest into stocks of catering to that pocket? And if you're not equipped enough to invest into stocks catering to that pocket, are there mutual fund schemes available to do the same? That's the question that we are going to try and answer on the show today. A bit later on in the show, we'll also have Amol Joshi, founder of Plan Rupee Investment Services, who will be talking about his thoughts on what funds you can invest into. But let's try and first verify the thesis of what we are trying to say. And to talk about that, a very important voice, a very well-known voice, needs no introduction, but Tushar Pradhan, CIO, HSBC Asset Management, joins me right now on the show. Tushar, so good having you. Thanks so much for taking the time out.
Thank you.
This is your first appearance on the Mutual Fund Show, so thank you so much for being a part of the show as well. Now, before we get to how could people invest into funds to plan this cycle, is this true? Do you believe that we are in the starting throes of what could be a big or a good cycle for infrastructure in the country of India?
Yeah, I think it's an interesting question that you bring, because in my opinion, I think infrastructure, especially in a country like India, doesn't necessarily follow this boom bust cycle.
Okay.
What tends to happen is, in a country like India where we lack even basic infrastructure, whether it's railways, it's roadways, it's airports, we are so far behind what a normal developed country or even a developing country like in India is required to have to be able to kind of have the requisite growth. We lack that. So from an infrastructure theme perspective, we have so much to build that we will build through a boom and bust cycle.
Okay.
So even if the rest of the economy is coming down, it doesn't mean that you don't need roads. Even if the overall economy is showing signs of slowness, doesn't mean you don't need airports. So which means this need is fairly perpetual in India. However, what's happened in India is, because of certain structural issues, infrastructure has not been able to take off. So it would have been a very evergreen sort of investing theme. But what has happened is, because of these structural issues, they've also gone through a cycle.
Okay.
So the cycle is that initially everybody was excited, there were a lot of ordering and a lot of people bid for these projects. So the cycle started off very well. But as they went into these projects, there were such issues which came up which delayed the projects. And that actually coincided with the cycle coming off as well. So people now are assuming that the infrastructure theme is somehow related with the cycle.
Right.
But my opinion is, frankly, if I just explain to you the way I did, is infrastructure is a little away from the boom bust cycle. But it does benefit if the cycle starts to move up as well, and at the same time the infrastructure ordering also starts.
Right.
So there is a hint to tell you that maybe even this time would be the right time, because as you know, the government has done a lot to kind of ease all the issues around the infrastructure projects themselves.
Right.
And it's now again aligning itself with the rest of the economy also picking up. So you would argue that yes, is infrastructure a great place to be in?
But there's a question mark out there, Tushar. The GDP numbers that came out recently aren't inspiring. If you frankly look at what the expenditure of the government is for the first few months of the calendar, it's almost reached levels of 92%, if I'm not wrong. So in light of this, are we still some time away, or do you believe that this could well be the starting stages of government funding and pursuing infrastructure growth in a big way?
It's a good point you make, and we always get stuck with this 6.5, 7, 7.5, and 8%, right? But we are forgetting a very key element along the way. So the last time we had 8% growth was about 10 years ago, right? 2006, 2007 is when we were hitting that 8%. But 10 years ago, our nominal GDP was nowhere near to where it is today.
Right.
So 8% on that number wasn't adding too much to the nominal economy as much as 6% will add this year. So I think people are missing out a huge bit when they say, oh, but it's below 6%. It's, you know, it's just like saying in China as well. After some time, we all agree that China will now grow slower than in India, but nobody worries about China suddenly disappearing out of the map.
Sure.
It's just that once you build a huge base for yourself, your rate of growth is going to be much lower than what you've seen historically.
Got it.
So I don't think we need to particularly worry about this number, because in any case, it's a quarterly GDP number. We have to wait and see whether it does get better. Of course, bigger is better. So I'm not arguing that we need to be growing at this rate. Maybe we can definitely grow faster, but I don't think we need to be alarmed about the fact that it's 6.5% as opposed to 7%. Because the base itself is now close to, what, $2 trillion now?
Yes. Okay, so that's interesting. Some thoughts from Tushar on what the GDP, if not the GDP growth really, what stage of the cycle we are in, and what within the stage of cycle as well of the country and GDP growth could infrastructure be in. He firmly believes that there is no boom and bust cycle for infrastructure. You could almost have a perennial boom cycle in infrastructure if indeed the spending were to be done in a way that could satisfy the economy. Okay, but here's the question. Since there's so much talk about infrastructure, could there be a pickup in infrastructure spend? The government is certainly saying it will. Tushar out here believes that we are probably poised for that. I think Jayesh Khilnani has done some fairly interesting research on infrastructure funds or funds, thematic funds as well, and what they do typically in cycles such as these. Take a look.
So Neeraj, India's latest GDP number came in at 5.7%, which was much lower than what the analysts were expecting or what was there in the previous quarter or the same quarter last year. Now, since 2012, the GDP number has oscillated from a low of 4.3 to a high of 9.1. During the last 10 years, the Nifty has just more than doubled. But here's a list of some of the infrastructure funds that have given you equivalent results or just better than what the Nifty has given you. So Canara Robeco has given you as much as 174%, with ICICI Pru giving you the least return of 117 odd percent. But the key question to ask, will these funds outperform going forward in case the GDP is or the economy is likely to revive?
Thanks for that, Jayesh. Now, if you looked at the kinds that Jayesh spoke about as well, there are some infrastructure plans that have come out. The returns, not bad, not the greatest, but not too bad either. Tushar, the simple question would be that if indeed the government spend on infrastructure picks up in a big way, can the returns of some of the infrastructure companies pick up as well? Because hitherto we've seen that while India has always been an infrastructure-starved economy, companies catering to this pocket really haven't set the stock markets on fire. Right. And stocks need to do well for a mutual fund to be able to do well. Do you believe that can happen this time around?
Yeah, I think again, when we talk about infrastructure, there is a very large spectrum of companies.
Sure.
Right? So right from power, as I mentioned, to roads, to rail. And even within these sectors, there are companies which set up the infrastructure. There are companies which help set up the eventual infrastructure. And there are companies which actually run the infrastructure. So for example, if I take an airport, it'll start from the fact that I need to acquire land to be able to construct it, which means I need a EPC contractor. I will need a lot of steel, I will need a lot of cement, I will need a lot of these manufacturing, units which will go into making up the airport. Then I will need logistics, I will need computers, I will need, satellite, I will need all sorts of other companies. Then eventually when I set up the airport, I will need operators. I will need to attract airlines, I will need to attract, the right kind of traffic. I will then be selling shopping malls within the airport. I will need to attract, all of those kinds of people, apparel, books, all sorts of things. And eventually, over this entire cycle, a lot of companies will participate in the infrastructure boom. So what I talk about is, when you talk about infrastructure, are we talking about the infrastructure operators? Because then you will just restrict yourself to airline Or you can say, well, we don't have privatized rail networks, but in the US, for example, Amtrak is a company which runs an independent railway system.
Sure.
So you could buy that because it's an operator. But everything that goes into making a railway network also is going to make money at some point of time, depending on the stage of development. So what we are talking about, the spend in infrastructure, really we are talking about companies which will feed that. And for that, you don't have to look far. It's your normal manufacturing companies. For example, infrastructure will require cement. Now, cement is a pretty well-known cyclical company.
Sure.
But if your infrastructure spend moves up, then they will suddenly have a large spurt in volumes. So all I'm saying is that while the cyclicality of the economy is also picking up, the infrastructure spend also will give rise to a lot of opportunities right now. So the question is that, is this going to actually coincide? Probably yes. And I see a lot of opportunity in terms of how the infrastructure companies will move up. But as I said, the definition is broad.
Yeah.
There will be a range of companies which will benefit.
And mutual fund schemes will adapt to that. Mutual fund schemes will not necessarily stay slave to pure play, what is termed infrastructure.
Yes,
they will pick up companies which kind of qualify for the theme and will benefit from this theme as well. Okay, so HSBC does have an infrastructure themed fund as well. Tell us about this.
So I think the one thing that is definitely distinguishing about this product is the fact that it's really true to label. So what has happened in the past is, obviously for various reasons, that the infrastructure theme has been very noisy. What I mean by that is, when infrastructure comes in play, then companies tend to get overvalued. And when suddenly they're out of favor, or some big major glitch comes in and there's a big delay, then all of the companies involved in it get a very large haircut, and they come actually off of that premium into discount. So if I'm buying an infrastructure related story, I'm going to have a very noisy experience. Over time, if the infrastructure project actually comes online and you start making money, I'll have a much smoother rate of return. But it's been a very noisy experience so far. So what we try to do is, we want to capture the noise for people. We don't like to make it, a little bit of everything, to make it, just like every other fund.
Right.
So you'll notice that our fund experience has been a little noisy, but it's been true to the theme. So you will not find, some kind of expanded explanation of what makes infrastructure in any of our companies.
But you would probably do that now, because the definition would have expanded.
It does, but we try to make sure that it stays within the theme, to be as true to the label as possible.
But so my question to you, Tushar, point blank, would be that, as you said, yes, the performance has been a bit noisy. For people who want to make a fresh investment, you would reckon that with the whole basket spending on infrastructure picking up, there is a higher probability that the kind of performance that the fund has shown over the last 5 years will not be a reflection of what the fund will do in the future.
No, in fact, I'd like to rephrase that to say that whenever infrastructure as a theme will pick up, the pure play will definitely do better.
Okay, fine.
That is what I meant. So for example, if you really focus only on infrastructure, then the upside that you get because it's running will be the maximum. And as an investor, why would I buy a thematic? Because I want to capture that upside.
Got it.
But I know that it is a thematic, it will be noisy. Because the times that the theme will not run, I will definitely do much worse than the rest of the diversified group. But if I have bought an infrastructure fund, then I should get exposed to that theme as much as possible. And that's what our product definitely does.
Okay. So with the, I know you can't answer fund specific questions, and I'm not asking you to, but if you were an investor into any infrastructure theme product right now, any, not just HSBC, would you prefer the SIP route, because you don't know when will infrastructure finally pick up? Would it be 2 months, 3 months, 6 months, or 1 year down the line? Or would you believe that because we are pretty close to it picking up, go out and invest a large chunk of money right now in that theme? Because as you said, the beta that you get, or the upside that you'll get whenever it does pick up will be quite substantial. What would you do? What would you advise?
It's a question which has an answer in itself, because typically when we say SIP investing, we are actually talking about dollar cost averaging, or in India it's called as rupee cost averaging. Now, how will your rupee cost average work for you? Only when you have peaks and troughs.
Okay.
If you have a much lesser varying price pattern, then your average is close to whatever it is varying at, right? Because it has a very large deviation, your rupee cost averaging will be significantly in your favor if the stream is much more volatile. And that's why equities as a class, which is very noisy, is a preferred SIP candidate. Because you're capturing both. You are not worried whether I'm buying at the right time. I'm just buying all the time.
Got it.
Which is similar to what my strategy and my thinking is that all investment savers should be doing, is that they should not worry about whether the market is the right time to be investing. Whether it is hot, whether it is cold, this is the right time. Just keep investing throughout the cycles. You will average out and you will end up making the return of the asset class over a long period of time. And more so in infrastructure because of the noisiness of the data itself.
So that's a great advice. Okay, we have one question, Tushar, before we let you go. It's not essentially on a fund, but Amitabh Arolkar, amongst others, is saying, is asking a question about what's the average multiplier effect for the government spend in infrastructure?
Well, it depends again. It's because of the kind of multiplier that the government can achieve. Say, I'll give you an example. Suppose you are talking about a very mandated or a normative environment. Say, for example, railways. Now, the railways have a social responsibility to deliver in a country like India, that they should make it cheap for people to transport themselves in a country which is not that affluent. Now, if I'm a railway operator, I have a limit in terms of how much I can charge my customer, right? So while the investment is the same, whether I invest in a railway network in India or a railway network in the UK today, my marginal cost of putting that up will be the same. But how much can I charge per customer? How much can I make money on this operation depends on this. And the multiplier then gets a little bit of hue from there. I would simply think that it should be as a rule of thumb between 2.5 to 3 times. So the kind of investment that you do, generates, a lot of volume for every related industry, about 3 times its size over the next 5 or 6 years.
Okay. That's a fair explanation. Tushar, thank you so much for taking the time out, and we look forward to have you more often on this forum as well. It was a pleasure talking to you today.
Thank you.
Okay, that's Tushar Pradhan talking about his thoughts on mutual fund investing and infrastructure as a theme, more importantly. But I think the common advice that came out today, or the key advice that came out today from his end, was that don't try and necessarily time an infrastructure theme or any other theme. It might be not a bad idea to do it right now. Otherwise, just stay invested and keep on investing. That might help. And that's something that Amol Joshi tells me every single time we talk, and we have him back on the show for the second time. Thank you so much, Amol. It's a pleasure having you.
Neeraj, pleasure to be here.
Yeah, thanks. So Amol, we're just talking to Tushar as well about economic cycles and mutual fund investing. Now, my question to you is, Jayesh had looked at a list of mutual fund themes which cater to the infrastructure theme.
Right.
And the returns haven't been staggering. I mean, 100% over 5 years is good, but it's not like the greatest. Right. HSBC fund, for example, and Tushar was right, the performance has been very, very noisy. The 5-year performance has been very, very patchy. Should people look at these themes?
Right. I think, as you said, sector funds, be it infrastructure sector, pharma sector, IT sector, any fund, sectoral funds need 2 things. One is you should get your entry point right. Another one is you should get your exit point right. Because sectors can have extended cycles of bullish cycle, up cycles, as well as down cycles. Right. And that's, I think, precisely what Tushar said. The performance has been very, very noisy. Anybody who cannot, any investor who cannot tolerate or does not want to see too much of ups and downs, that person, that investor is better served by diversified suite of funds instead of infrastructure or any sector fund. This is what I firmly believe. And see, mind you, Indian investor traditionally is a saver, right? We have our highest amount of money, domestic retail money, saved in fixed deposits. So Indian investor is somebody who wants to see consistent returns. He or she doesn't mind slightly lower returns, but I don't want to see my money going down. Again, if that is your concern, despite of being in equity, you will see a much less volatility in diversified funds as compared to infrastructure or any sector fund.
So for a risk taker, Amol, you would reckon that subscribing to a thematic fund like an infrastructure fund might still not be a bad idea if he knows what he's doing.
Exactly. So that was my first point. You should get your entry point right, exit point right. If you are somebody who tracks the sector, if you are someone who wants to truly have that high risk, high return kind of a allocation in your portfolio, then sector funds, including infrastructure, surely does qualify for such an.
Do you have a particular view on infrastructure funds? I mean, not all sectoral funds, but infrastructure in particular. You may not. I'm just asking you.
Right. So infrastructure funds can form a part of about 5 to 10% of the allocation. That too, if you are comfortable with high risk, high return, and extended periods of volatility, or even extended periods of underperformance. I think I shouldn't. We all know the data. 2007-8, 2006-7-8, you had flurry of infrastructure funds because that was the theme, and then many of the funds are yet to recover the NAVs of that era. Considering that, only about a 5 to 10% of allocation for a regular investor. We are not talking about the specialist. Somebody who can do his or her own research, can time the entry and exit levels, makes a lot of sense for them. But for a lay investor, at max 5 or 10% allocation in the entire portfolio.
Okay, that's sound advice. So please, I hope you noted that down. In which case, Amol, let me ask you, what is it that you are recommending to your clients right now? Again, we know, please mind viewers, it's not a one size fits all. So again, what Amol is recommending is, to the best of his knowledge, something that could largely be applicable to people, but it could be very, very specific. So please consult your own financial advisor if you don't have one. Amol Joshi or any of the others appearing on the Mutual Fund Show are sound names. We do our due diligence before we call them as well. But Amol, as a generalist view, if not a thematic fund, for somebody who's not a big risk taker, what are the options available currently?
Right. So I'm driving from the key point what you mentioned just now, somebody who's not a big risk taker. So asset allocation remains the bedrock of any financial plan, any investment plan that you are constructing for your own self, for your clients. When we talk about asset allocation, there is something very, very interesting. The funds are there for quite some time. The funds are balanced funds, and recently you have dynamic asset allocation funds. Dynamic asset allocation funds first. As the name suggests, these are the funds that invest in a mix of equity as well as debt, fixed income, thereby giving you or the fund manager an opportunity to choose the equity allocation on any given point in time. Cut to the present, you have market at 31,000, 32,000 levels. The P for the index is close to 25. Various experts or various investors do believe that these levels are elevated levels. During such times, dynamic asset allocation funds currently, most of them are maintaining equity exposure of around 45 to 50%. The rest of around, for any fund to qualify as an equity fund, you should have minimum 65%. So any fund that has, let's say, 45% equity, around 20% of exposure to equity is taken via the derivatives, and rest of 30-35% portion is of the debt funds. So you get benefit of equity taxation. The fund manager can choose equity levels in the portfolio dynamically, and thereby giving you best of both worlds.
So my question is, sorry, you were saying about?
No problem. So I was saying that in balanced funds, however, the structure is slightly more rigid. Balanced funds will always maintain 65% kind of equity exposure. So there is someone who wants to take an equity exposure of 2/3, 1/3 debt for the stability of the portfolio. Balanced funds will serve that investor well.
So what would you choose, a balanced fund or a dynamic equity fund?
Right.
They sound similar.
Yeah, they sound similar, but I think I had just clarified the
No, at the current point of time, what will you choose?
I would, at this point in time, I would, for majority of portion, I would choose the dynamic asset allocation.
Dynamic asset allocation. So the Motilal Oswal most focused dynamic equity fund, is that something you're recommending?
Yes, that is something I do recommend. That is one of the new funds. This fund is less than 1 year old. It will complete 1 year in the month of September. However, you have established names.
ICICI Prudential.
ICICI Prudential Balanced Advantage. This is an established name, one of the largest funds in the category. This fund, and now, this is very, very interesting. This fund has beaten Nifty. Obviously, we are talking about a 100% equity portfolio. This fund traditionally has maintained equity between 45% to 60% levels. Last 5-year weighted average is around 57%. Despite of having less than 60% equity, the fund consistently beats Nifty. So you can imagine the kind of value that asset rebalancing adds to the portfolio. Very, very interesting. I think you will find.
Okay, so the ICICI Prudential Balanced Advantage Fund. There's also the Motilal Oswal Most Focused Dynamic Equity Fund. A couple of funds that Amol is recommending. Just before we wrap up, Amol, and the final fund, it's not a dynamic fund, but
it is not.
Savings Balance Fund, Reliance Regular Savings Balance Fund. Why are you recommending this one?
Yeah, okay. So if I'm not wrong, this fund we discussed in our last time we met on the Mutual Fund Show. This fund is one of the most consistent balance funds. So mind you, this is not dynamic asset allocation. This fund maintains between 65 to 70% of equity exposure. Why today this fund and why not other dozen funds or more that are available. This fund also consistently maintains allocation in the large cap. So we made one point. Who should go for balanced funds or dynamic asset allocation funds? Somebody who is conservative, somebody who doesn't want to take too much of risk. Now within that, measured on the P scale, you have mid cap and small caps, slightly on overvalued zone compared to large cap. From that point of view, Reliance Regular Saving Balanced Fund, which has largest allocation in the equity component belonging to large cap companies, makes a lot of sense, and hence that fund makes the cut last time as well as this time around.
Great. Amol Joshi, thank you so much for joining us today and giving us your thoughts and your recommendations as well. It's a pleasure having you.
Neeraj, always a pleasure.
Okay, and viewers, thanks for tuning in. Hope you got your answers. If you are indeed a risk taker, maybe a thematic fund, maybe an infrastructure fund. Otherwise, there are the other options available which Amol just highlighted. Thanks for tuning in this Wednesday on the Mutual Fund Show. We'll be back next Wednesday with another theme. Thanks so much for watching.